Market Recap. I'm Daniel.
And I'm Mira.
So imagine you're opening your trading terminal on a Sunday night, and you're just expecting absolute panic.
Right, because of all the headlines.
Exactly. You look at the news, and oil is completely collapsing. Gold is plummeting. The U.S. dollar is, well, it's acting like a cross-asset wrecking ball, just destroying everything in its path.
It's a scary setup for sure.
Yeah, so you brace yourself, right? You look at the corporate credit markets, fully expecting companies to be pricing in this economic apocalypse, but instead it's just completely flat. The credit market is essentially shrugging it off. So, welcome to our deep dive.
It's the ultimate paradox, really. And honestly, it's exactly why we do this.
Yeah. Today we're taking our stack of source material, the raw market data, the explosive holiday news flow, and all these shifting geopolitical tectonic plates, and we are giving you your essential Sunday night shortcut.
The goal here is to make sure you are totally well-informed on the macro backdrop before the new trading week begins.
Right. Our mission is to unpack this massive holiday weekend where, honestly, the surface data completely contradicts the geopolitical reality.
And just a really quick note before we jump in, this deep dive is for market context and discussion only. It is absolutely not personal investment advice or, an investment recommendation. We're just mapping out the baseline landscape you're operating against.
Perfect. So let's jump right into our first major question for today. Session 1, how did the markets actually move over the past week?
Well, if you were only looking at the surface level of U.S. equities between June 15th and June 19th, you'd probably think it was a pretty boring week.
You really would. I mean, it looks so calm.
Yeah, if you just glance at the S&P 500, you'd see this choppy sideways consolidation. We had a bit of a midweek slump on Wednesday, dropping to a low of 7,420.6.
But then it caught a bid, right?
Exactly. It recovered nicely to 7,500.58 by Thursday's close, just right before the Friday cash market holiday. And volatility basically went to sleep.
Yeah, the VIX just compressed steadily all week, right?
It did. It went from an intraday high of 18.44 down to 16.78. It paints this picture of total calm.
But, looking at the S&P right now is it's like looking at the calm surface of the ocean while there's a massive hurricane raging underneath.
Oh, absolutely. The real story was underneath.
Right. The wrecking ball of the week was King Dollar. The U.S. dollar index, the DXY, surged to a commanding 100.85. It just took total command.
And when the dollar surges like that, it mathematically crushes the commodity complex.
It's brutal, and it happens so fast.
Because, commodities like oil and gold are priced globally in U.S. dollars. So a stronger dollar means it takes fewer dollars to buy the same barrel of oil or the same ounce of gold.
It acts as this immediate deflationary force on those physical assets. And we've talked before about dollar strength as imported inflation for the rest of the world. But the sheer magnitude of the carnage this week was just staggering.
It really was. Gold plunged from 4,358.9 Z down to 4,172 bedros in just a matter of days.
That is not just normal volatility. And WTI crude, it completely collapsed, tumbling down to $76.54 a barrel.
A violently aggressive rotation. And normally, Daniel, when you see a foundational asset class like commodities experience that kind of severe, rapid depreciation, it triggers alarm bells across the whole financial system.
Right. Specifically, it usually triggers total panic in corporate debt.
Exactly.
And this is exactly where I find myself genuinely confused by this standard narrative. Like, wait, hold on. If oil and gold are falling off a cliff, normally corporate debt starts pricing in a recession, right?
You would think so, yeah. Borrowing costs for industrial companies should be spiking.
Spreads should be widening. But I'm looking at the credit markets, both high-yield junk bonds and investment-grade corporate bonds, and they essentially didn't move an inch all week.
It's wild. High-yield credit, HYG, stayed perfectly flat at 80.01.
And investment grade, LQD, remained totally flat at 109.807. So if the sky is falling in commodities, Mira, why is the credit market just whistling past the graveyard?
Because the credit markets are actually telling us a completely different story than the commodity markets are. What we're seeing in real time is markets pricing the removal of tail risk.
Okay, let's break that down. What does that actually look like on the ground?
Well, think about it from the perspective of a corporate bondholder. You only panic if you think the company won't have the cash flow to pay you back.
Right.
So the total lack of distress in corporate credit right now shows that investors view U.S. corporate cash flows as incredibly structurally resilient.
Ah, so the underlying economy is still generating enough real cash to withstand the commodity volatility.
Exactly. The credit markets aren't seeing a systemic wave of corporate defaults. They're just seeing a localized, isolated repricing of inflation premiums in the physical commodity space.
Okay, so to summarize the week's price action before we take a quick breather, we essentially have a resilient equity market and this unfazed, confident credit market.
Yeah, both of which are masking some violently aggressive under-the-hood rotations driven by a surging dollar and collapsing commodities.
That is the baseline. We're going to take a very short break, but when we come back, we're diving into the explosive holiday headlines that actually pulled the rug out from under oil in the first place.
Stick around.
All right, we are back. So let's get right into it. Mira, how would you frame our next section?
Let's frame it like this. Session 2. What were the key news events over the holiday, and what are their market implications under our contemporary macro context?
Perfect. To set the stage for this, if you recall from the Watch Next section of our most recent trading recap, the U.S. equity and Treasury cash markets were closed on Friday, June 19th for the Juneteenth holiday.
Right, which technically set up Monday's Chicago Fed National Activity Index as our next immediate economic data point.
But as we know, geopolitics certainly doesn't care about market holidays. The international news that dropped over the long weekend was honestly genuinely historic.
And it entirely explains why oil fell off a cliff.
Yes. Let's start with topic A, the Middle East ceasefires and the oil collapse. Break down the facts for us.
Okay, so on Wednesday, June 17th at 5:24 p.m. Eastern Time, the U.S. and Iran officially signed a digital memorandum of understanding.
Wow.
Yeah, this effectively ends the conflict and lifts the U.S. naval blockade. Then, fast forward to Friday at 4 p.m. local time, an Israel-Hezbollah ceasefire officially took effect.
So the critical Strait of Hormuz is finally reopening to commercial shipping.
Exactly. And on top of that, Kuwait immediately lifted its force majeures, meaning they're rapidly ramping up their oil output and refining capacity to flood the market.
Now, I have to look at this through a game theoretic lens for a second. It is so easy for the financial media to treat these geopolitical events like unpredictable natural disasters.
Like an earthquake that just suddenly resolves itself overnight.
Right. But let's remember, geopolitical brinkmanship is bargaining leverage. I don't buy that this was just some sudden diplomatic miracle.
You think it was timed?
Well, did Iran deliberately hold out on these negotiations, suffering through the blockade until the absolute maximum point of leverage? We are right on the precipice of U.S. elections, moving right into peak summer energy demand.
It's a very fair point.
It feels less like a sudden change of heart and more like a calculated exhaustion of leverage before finally accepting this 60-day window.
It is a highly strategic environment, absolutely. But, regardless of the exact strategic motives behind the timing, the market implication is immediate. It's mathematical and it's undeniable.
Because it directly removes that stagflationary tail risk.
Exactly. By allowing normalized global oil flows through the Strait of Hormuz, you eliminate the primary physical supply shock that triggered the massive energy spike we've been dealing with all year.
And we know that energy prices act as a consumer tax. I mean, every dollar a consumer isn't spending at the gas pump is a dollar they can spend at a restaurant or, a retail store.
Right, it's a huge shift in discretionary income.
So this drop in oil down to the mid-70s is a massive, immediate injection of financial relief for global consumers.
It is.
But this brings us to topic B and the massive contradiction in the weekend data. If the energy tax has been repealed and consumers are getting all this relief, why are global central banks panicking instead of celebrating?
Because of what else unfolded in the data over the holiday. It was a synchronized hawkish shockwave.
Let's talk about the Bank of Japan first.
Yeah, the BOJ signaled an imminent and structural hawkish shift. Deputy Governor Himino came out and explicitly stated that Japan's core inflation is becoming entrenched.
So it's no longer just a temporary supply shock from energy prices.
Exactly. It's being driven internally now by robust corporate profits and structural wage growth. And when wages go up, inflation becomes sticky.
And it wasn't just Japan panicking.
No, not at all. Concurrently, you have European Central Bank Chief Economist Philip Lane warning that Eurozone inflation is going to remain stubbornly above 3% for the rest of the year.
Central banks are terrified of inflation as a self-fulfilling spiral, right? Where strong wages and robust profits keep prices elevated regardless of what happens to the price of a barrel of oil.
Exactly. And the most vital part of this for U.S. equities happened right as the long weekend kicked off. Traders looked at this global hawkish pivot and fully repriced their Federal Reserve expectations.
Right on Friday morning.
Yep. Markets are now actively pricing in a 25 basis point outright rate hike by September.
That is huge. We have completely gone from hoping for rate cuts to bracing for actual hikes, which, brings us to topic C, the AI infrastructure supercycle.
The great counterbalance to higher rates.
Right, because this fundamentally changes the valuation math for equities. We always say discount rates act as financial gravity. When borrowing costs go up, valuation multiples are supposed to compress. Gravity pulls things down.
In a normal market, yes.
So here is my vital question for you, Mira. Think of the AI capex boom like a runaway freight train. If discount rates are financial gravity and the Fed is actively applying the brakes with higher rates, why aren't these massive tech valuations collapsing under the weight? Why is the train just overpowering the brakes?
Because capex is acting as a market fragility mask. Ordinarily, higher real yields would absolutely crush equity multiples. But the sheer velocity and physical scale of the $700 billion AI infrastructure build-out is entirely outpacing those higher discount rates.
It's just too big to be slowed down.
Exactly. We're talking about AI capex as a cycle-agnostic arms race. These tech giants simply do not care what the federal funds rate is right now.
They have to build the data centers or they lose the future.
Bingo. And the numbers we saw over the holiday back that up perfectly. Meta just struck deals to secure 1.6 gigawatts of computing capacity from sites in Texas and Missouri.
Just to put that in perspective, 1.6 gigawatts is enough to power a major American city, and they are locking that down just for their servers.
It's staggering.
These companies are generating so much cash and expanding their physical footprint so aggressively that it completely overrides the drag of higher interest rates.
And crucially, they've just got a massive regulatory gift to keep that physical momentum going.
Yes. This was the under-the-radar headline of the week. On Thursday at 11:28 a.m. Eastern Time, the Federal Energy Regulatory Commission, FRC, unanimously ordered grid operators to accelerate interconnection procedures for massive AI data centers.
This is huge because we've talked endlessly about power access as the AI bottleneck.
Right. You can design all the advanced chips in the world, but if you can't physically plug a gigawatt facility into the local power grid, those chips are just useless glass and silicon.
And grid connection usually takes years of red tape. But the U.S. government just looked at that red tape and cut right through it. They fundamentally de-risked the tech sector's infrastructure roadmap.
It's a profound catalyst. But it leads us nicely into topic D, geopolitics and trade friction, because it creates a fascinating contrast with the rest of the world. While the U.S. tech sector is physically building out, the geopolitical landscape elsewhere is politically fracturing.
It really is a completely bifurcated global economy right now. Over in the UK, for example, core retail sales surged by 4.6% year over year. That massively beats expectations.
But they aren't celebrating.
No, instead of celebrating a strong consumer, the UK Labour Party has plunged into an internal civil war following their parliamentary elections. You have incoming factions demanding an immediate end to trickle-down economics and pushing for heavy northern reindustrialization.
So the economic data is strong, but the political friction is dragging them down.
Exactly. Meanwhile, in North America, the U.S. and Mexico are actively cementing their economic ties through a comprehensive USMCA trade review.
And at the exact same time, the U.S. Commerce Department formally warned the Dutch semiconductor giant ASML about their equipment potentially flowing into China.
Adding another layer to that U.S.-China dynamic. Trump just invited Chinese President Xi Jinping for a September 24th White House visit.
When you stack all of these puzzle pieces together, it paints a very clear picture. These moves actively consolidate U.S. supply chain dominance and accelerate North American nearshoring, while Europe is left struggling with internal political friction.
So if we look at the holiday news flow as a whole, Daniel, we are watching a massive global tug of war.
Perfectly said. On one side, you have the unstoppable physical force of the AI infrastructure build-out and plummeting oil prices giving consumers relief. On the other side, you have hawkish global central banks and rising discount rates trying to pull everything back down to earth.
It's setting up an incredibly tense week.
Which naturally leads us to a quick break. When we come back, we'll outline exactly what data points you need to watch to see who wins that tug of war.
Be right back.
All right, welcome back. Let's dive right into session 3. What should we watch in the coming week?
We have an absolute gauntlet of macroeconomic data ahead of us. Here is your definitive what next list for the incoming week.
Lay it on us.
On Tuesday, June 23rd, we get the flash S&P Global US PMIs for both manufacturing and services. That's going to give us a real-time read on economic momentum.
Okay, what about Wednesday?
Wednesday, June 24th brings May new home sales.
The Thursday is the main event, right?
Well, Thursday, June 25th is a massive data dump. We get Q1 final GDP, durable goods orders, weekly jobless claims, and crucially, the May PCE and core PCE inflation data.
The PCE is the Federal Reserve's preferred inflation gauge.
Exactly. That single print is the ultimate read for the Fed's rate path and the direction of the U.S. dollar. Finally, on Friday, June 26th, we wrap up with the final June University of Michigan consumer sentiment and inflation expectations.
Well, enjoy your Sunday evening drive now that the Strait of Hormuz is open and oil is finally dropping like a rock.
Yeah, enjoy the cheap gas.
Just don't celebrate by putting dinner on the credit card because the market is fully pricing in another Fed rate hike before the leaves change. It's the classic 2026 market trade-off. World peace is back on the table, but your borrowing costs are still a national tragedy.
So true.
Take a deep breath, reset your alarms, and let's see if the AI tech build-out can carry us through.